Okay, so I don't know if you guys watched the GME video or not, but I'm not going to specifically get into GME unless I'm just going to get into it really quick just to show you guys. Just very important, when we're trading options. So whoever was in calls for GME, I went over this on the video, but let's just go over it right now. So, okay. So first of all, I hope at this point everybody is familiar with 3-trigger cluster setups. That's when all 3 triggers cluster together like this, and then price moves in one direction. Whichever way it breaks, we expect a strong trending move to the upside. Now, right off the bat, a couple of things stick out to me here. One, we have the bounce off the 5-minute trigger, second bounce, third bounce, fourth bounce, fifth bounce, and sixth bounce. Now, if you're just watching the chart here, there's no way to know if the 5-minute trigger is going to provide support or not. But when we pull up the hourly velocity, you see how strong the hourly velocity was in these hours. So if you're in a call position and you see that the hourly velocity in this hour, right? So we're in this hour right now and we get the predictive print for the next hour. So right here at 11:30, we had the print for the next hour. When you see the velocity jump like this, you're expecting the 1-minute trigger to provide support, and especially the 5-minute trigger to provide support. Then at 12:30, we got the next predictive print that the hourly velocity was going to be higher than it was the previous 3 hours. So during this entire hour, we knew that we're moving with higher velocity and price should go higher. And whether price goes higher or not, we're definitely expecting the 1-minute trigger to provide support. Now, one thing that I didn't go over enough on the Discord that I want should be, pretty clear is this kind of print, this hourly print. Let's remove the 1-minute trigger and the 5-minute trigger. When the hourly velocity just dwarfs the previous velocity prints, it's called a capitulation print. It means it's running too hot and it needs to cool down. Now, you also see this on every time scale, like the 1-minute velocity. You see this? This is capitulation. When you see the 1-minute velocity running hot like this, too much velocity, price needs to cool down. Now, usually it'll resolve to the upside after a cool down. So too with the hourly velocity, usually it'll resolve to the upside after a cool down. But it's important to note that it's not only bearish divergence or bullish divergence that gets you out of a trade, it's also capitulation prints. If we look at the 5-minute, yeah, so this is very obvious. When the 5-minute just dwarfs every other print, then it's a capitulation print. Now, right away, we draw a downtrend line off the velocity. Okay, so right here, this print, draw a downtrend line to here and keep drawing it down. And when 5-minute velocity breaks out above the trend line again, so 0.11, 0.08, I think it should be about 0.06 or 0.05. So on Monday, if we see a velocity print of greater than 0.05, that means that 5-minute velocity broke out of the velocity downtrend and price will follow with a breakout. Okay, now let's go over a couple of ways that we could have got out of our position. So first of all, for weeklies. Okay, so you don't even need the triggers for this. If you're holding weeklies, you want to get out as soon as you see 3 bearish divergences. So here is your most extreme print to the upside. 1-minute velocity is 0.12, and here's your price high of 27.84. Here's your first bearish divergence because price makes a new high, but the 1-minute velocity obviously does not. And here's your second bearish divergence. Now, once you see 2 bearish divergences on your free Anemoi charts and you're holding calls, in your minds, your logic, your thought process should be, as soon as I see another high and the velocity print does not exceed this, and it should be obvious at this point that the next high, there's no way the 1-minute velocity is going to exceed it. But even if not, in your minds, as soon as you get a new high, that is the sell signal, and especially if the 5-minute agrees. So if we look at the 5-minute, here was your most extreme 5-minute print. Price was 27.54 at the time. Okay. Here's your first new high, bearish divergence, velocity does not make a new high, and here's your second new high. So again, if price makes a third new high with bearish divergence, it means price will automatically revisit the 5-minute trigger, which it did, right? As soon as you had your third high, came straight back down to 5-minute trigger. So again, 1, 2, now you're watching this live. As soon as you get your third print, you're out. That's if you have weeklies, okay? When I swing trade and when I'm in SPY calls or SPY puts, this is what I'm doing. I'm buying let's say I buy my calls or puts above the hourly trigger, especially if there's a 3-trigger cluster. And then I find my first extreme print to the upside or to the downside. Then I see my 1 bearish divergence. I see my 2 bearish divergence. And then I'm waiting for a third high to get rid of my weeklies, or especially ODT. And as soon as, and that's how you could pretty much maximize on these plays. Okay, now obviously there's always a safety measure. Let's say you have this extreme print and then price just tanks. So how do you protect yourself? Well, that's where the 1 and the 5-minute trigger come in handy. there's a couple of ways to do it. If you have a longer term position, you can use the 5-minute trigger as your stop loss. You know, price closes under the 5-minute trigger for like 5 minutes, you get out. You would have been in the entire. I think somebody's unmuted. I'm just gonna mute them if you guys don't mind. 1 second. Okay. So your safety measure is you're hiding your stop loss under the 5-minute trigger. So you literally could have been in this play the entire day. But if you want to time the exact tops, wait till you get your 2 divergences and sell on the third one. Gavin actually called the sell right here, right? And then, you know, another thing is you could always use your 1-minute trigger as your stop loss. So at this point, right, let's say you have a little bit of FOMO and you like holding till the very end, okay? And so price is up here and you're like, I know that there's 3 bearish divergences, but I'm not convinced that price is just going to reverse. So just hide under the 1-minute trigger. You don't need to hide under the 1-minute trigger over here because you didn't have 3 divergences yet. So as long as you don't have 3 divergences, price should continue moving in that direction. Price is going to continue moving in the bullish direction until you have 3 bearish divergences. So once price breaks above the hourly trigger and, you know, pulls back and moves under the 1-minute trigger, this shouldn't scare you. Under the 5-minute trigger should scare you, but the 5-minute trigger should hold. All right. Once you have your 3 bearish divergences, if you don't want to sell the top, at least use the 1-minute trigger as your stop loss. And so on Friday, if we go to, you know, Gavin's channel, I'll just take a look at this for a second. Or was it mine? Let's just see. Yeah, the GME 1-minute trigger is 28.17. I'll be using that as a stop loss. I can always re-enter on an airplane setup. So 28.13, and then so that's where the 1-minute trigger right here was 28.18, but price bounced to the upside, and then when it came down here, that's when I was out of my position, right? And that although it wasn't maybe the top for the day, like price did make another bounce. We bought them yesterday down here, so still really good profit. So again, these are all the ways you can get out of your position. You can use the 5-minute trigger as your ultimate stop loss. Okay, I'm talking about 3 trigger cluster setups, and we expect price to continue moving strong. You can use the 5-minute trigger as your ultimate stop loss. You can get out of your position on 3 bearish divergences. Even after 3 bearish divergences, you can wait for a move back below the 1-minute trigger. Or the last option is you can just keep holding. If you have calls expiring, let's say it was a Tuesday that this move happened, and you have calls expiring Friday or next Friday, there's no reason to ever get out because the only time you need to sell your position is once the 1-minute trigger crosses below the 5-minute trigger. Once that happens, you're probably done. The move, at least the 3 trigger cluster move, is most likely done. So, you know, as long as the 1-minute trigger doesn't cross down, you're fine to stay in the position. I personally would have stayed in this position if it wasn't a Friday. So that's how we manage risk. That's how, you know, those are all the ways to get out. I'm not sure. It's glitching. Okay. So if anyone has any questions on that, otherwise we'll go on to the next subject. Okay. Now let's talk macro. So again, most of this I discussed on the GME video, but I don't see a problem with quickly reviewing it in case anyone didn't watch. What happened on Friday that was very important was that the weekly velo, the negative weekly velo, got cut in half. So if you pay attention to the macro market and you look at SPY and you look at all the major market averages, when they take it up on a Friday, what it does is it repairs the negative weekly velo. Negative weekly velo had been stepping up and getting better for us, but because of Friday's move closer to the weekly trigger, we really cut it. We cut it from negative, let me remove everything else so you guys can see it clearly. We cut it from negative 4.1 all the way to 0.17. So we cut it more than in half. So, you know, they don't let this happen unless they can stop it, because now it's going to be a lot easier for GME to move bullishly. Like during this entire time period, you see how it was just, you see how it was just completely flat, right? And no matter how many times right here, right here, right here, right here, price tried to break out 4 times, got rejected each time. And it was mostly flat and sideways trading with no volume. Why? Because look at the monthly velocity, okay? The monthly velocity was nasty, telling us on a macro scale, sellers are going to be in big time control here. And the weekly velo was also nasty. But now, all of a sudden, you're going to see more volume, more activity. Why? Because the negative weekly velo is getting much less. The daily velo, for the first time since August 22nd, is now positive, and it's a significant print. Like this print was 0.04. Anytime it's a 0.0 anything, it's not that significant. 0.139. Now we're talking, all right? Now we got some real daily velocity. So when you see all this volume and all this volatility coming in and GME is moving a lot faster and harder in each direction than it was this entire time period, you know why. It's because of the positive daily velocity. We also had hourly velocity breakout. Okay, so that actually started a couple of days ago. I don't know who was on that live stream when I discussed it, but I said what we do is we draw a downtrend from this print down to this print. No, actually, it was a little further back. Let me see if I can find it. Yeah, it was from here to here. No. Oh, that's interesting. I think we were in this area. So we drew a downtrend from 0.14 to 0.10, and we said that anything over like 0.7, which would be right around here, if you continue with the downtrend, should be a velocity breakout. And I said once velocity breaks out, price is going to follow. So draw the downtrend from 14 to 10. That means right about 0.8 or 0.7 velocity will break out. So on this bar, 0.10, that's when velocity broke out. Price ended up making this nice move down, came down, but that's a dip buy because velocity already broke out, and then we got this really powerful move to the upside. Now, just another example of a capitulation print. If we look at the daily velocity, you see how this bar just exceeded all of these, just swallowed all of these? That's a capitulation bar. So not only does bullish divergences get you reversals, but also capitulation bars. Another very important thing that happened on Friday was that the hourly trigger finally crossed above the daily trigger. Now you can see that this is kind of like the most important thing for macro trend. So here's when the first trigger cross happened, and we moved really nicely. And then we got this bearish cross, but price bumped into the monthly trigger and got a bounce. And then once we got this cross right here at $31, price moved all the way up to 40. Pre-split, that's a $40 move off a trigger cross. Imagine if GME moved from 130 to 170 in the span of July 8th to July 20th, 12 days. That would be pretty exciting, right? So trigger cross is usually preempts these big moves. And then here we have an airplane setup, which is when the hourly trigger comes down, kisses off the daily trigger, and returns back up. And that's also really bullish, and price went from 33 up to 47. So, pre-split, that's like a $58 move. So right now, we're in a very similar setup. Now, granted, we have a lot of overhead above us right now. This is really tough, the weekly trigger and the monthly trigger, which is why I'm completely flat right now until we're above the weekly trigger, because it's just, there's not much room to go up. We're going to bump our head against the monthly trigger and weekly trigger. If we break through, I'll be long at 30.60 instead of 28.35, whatever. And if we get a counter trend, move back down. So after you have trigger crosses like this, it's very common to get a counter trend move back down either to the hourly trigger or all the way to the daily trigger. If we get that kind of move, that's going to be an excellent buying opportunity, because with the positive daily velocity and the positive hourly velocity, we know that, this should hold for us. Now, every move that we have ends up looking like divergence, but here's a great example where there's no bearish divergence. So let's take a look at this. All right, we have this price high, 27.38, hourly velocity is 0.10. We have this price high, 27.41, and hourly velocity is 0.11. So no divergences there. Then we have this price high, 28.60, and hourly velocity is 0.17. So this tells you that the move is not done. GME still wants to move up, because velocity, with each move up, here, keeps moving up on a macro scale. So while things definitely look bullish, I'd like to see us above the weekly trigger and above the monthly trigger to be really bullish. Now, the monthly velocity, which is really negative right now, tells us that this monthly trigger will automatically be a rejection, but the month ends tomorrow. So the closer GME closes to 29.98, the better of a month GME is going to have in November. So let's see how that works out. Okay, let's get to the list. Who had the list? Half-Baked Empty Lunchbox had the list. Okay, so let's go through all of them. One second. Okay, first let's look at Tesla. We're just going to go over a bunch of potential plays, and we'll see which ones look the best. Okay, this is another fantastic example of Anemoi working like Anemoi should. So look at the monthly velocity here. See how the monthly velocity was positive when Tesla broke under the monthly trigger. This tells you that during the entire month of November, price wants to at least pull back towards the monthly trigger at 238. And Tesla, from a low of 198, was able to make a high of, let me check, a high of 233 this week. So I went long at 198 with MB. I sold at 210, whatever, big whoop. But this just shows you that Anemoi was telling you that the entire month of October, price wants to pull back up to the monthly trigger. So even though price came down, you had an excellent dip buy opportunity. Right now, I don't have such a great opinion on this, although if Tesla breaks above 238.61, that's going to be an easy long to 263. So is MB on here right now? Okay, so we're going to write, just going to save this list, Tesla above 238. Okay, now let's do beyond. I think this one was an interesting one, actually. Okay, so weekly trigger is 93% above where price is right now. Monthly trigger is 377%. So this is how we tell if price wants to visit these triggers. First, look at the monthly velocity. So there's nothing in the monthly velocity telling me that price wants to revisit the monthly trigger. If the monthly velocity was stair-stepping up, you see here how it's stair-stepped up. If it did that for 6 straight months, then I'd say price wants to revisit the monthly trigger. But because, it's even coming down here, there's nothing telling me that price wants to revisit the monthly trigger. Let's look at the weekly velocity. Weekly velocity, again, nothing really telling me that price wants to revisit the weekly trigger. So this doesn't stand out as like a banger immediately. Let's look at the daily velocity. Okay, this is going to be a great example of bullish Anemoi divergence. So, okay. So price, first of all, again, the importance of the hourly trigger, daily trigger cross. You see you get this cross and you get this crushing move down from $33 all the way to $12. So price gets cut by a third from a trigger cross. So again, powerful. This is a powerful setup, these trigger crosses. So now watch this. See how velocity keeps stepping down here? And then on this leg down, okay, you have one divergence, but nothing stands out yet. And then on this push down, you see how velocity keeps getting more to the downside? From here to here, it's no divergence. Price came down and velocity came down. So Anemoi is telling you that price is going to keep going down until you run into your series of 3 bullish divergences. When price comes down here, see how velocity gets worse? 1, 2, 3 times velocity gets worse. So Anemoi is telling you that, very simply, price wants to keep selling. But now we see a low right here of 1435, and the daily velocity is negative 6.2. Now here is your first new low. This is bullish divergence. Here's your second bullish divergence. And when price snaps up to the daily trigger, after only 2 bullish divergences, it means price is stronger than we'd expect. Basically, the way it works is that after 3 bullish divergences, so price making 3 new lows, but velocity does not. So here's your most extreme print, 1433. 1 new low, velocity is all the way up here, bullish divergence. 2 new low, velocity is all the way up here, bullish divergence. If we would have 3 of them, that's an automatic long every single time, and you can almost automatically expect price to shoot up straight to the daily trigger. Here, you only had 2 and price revisited the daily trigger. So how would we play beyond? Very simple. And this can actually work out really well. So the daily trigger is up here at 16. The hourly trigger is 1471. 2 ways to play this. You can either wait until the triggers get really clustered together. So price is going to bounce around here, reject here, bounce here, reject here, bounce here, while they get closer and closer. And if price squeezes through both triggers while they're tightly clustered within 1 or 2% of each other, then that means that price can attack all the way up to the weekly trigger, which is almost a 93% upside move with options. That's 1,000% of gains at the minimum. But another way to play this is we can play price breaking out of the daily trigger. That's the second way. That's a less confident way. And the greatest way to play this is we wait for price to break above the daily trigger. Then we wait for the hourly trigger to cross above the daily trigger. After that happens, we usually have a snapback to the hourly trigger or the daily trigger. Once that happens, we go long, and that's when we could expect price to come up and attack this. So let me give you an example. See here, when we had the trigger cross and there was no counter trend move, if there's no counter trend move, that means that the strength of the move is so strong that it couldn't even have a counter trend move back up. That means that it's going to be a powerful, powerful move. And sure enough, it was a powerful, powerful move to the downside. If price breaks above the daily trigger and the hourly trigger breaks above the daily trigger, either, if there's no counter trend move immediately, right, within the first day, then we know, okay, this is really, really strong, and we can long this trade to the weekly trigger. If there is a counter trend move, we get the best entry because we enter at 1601. Our stop loss is at 1580. Maximum loss is 10%. Maximum win is unlimited. We can make 1,000% on this trade, longing this to 30. Now, when you have stocks with high short interest that break above the daily trigger, the short's pain limit is the daily trigger. So when this cross happens, that tells you on a macro scale, there's a strong sell program coming into the market, and you can expect price to get crushed to the downside. But once price breaks above the daily trigger, the same short program that shorted the shit all the way down is now going to step in and cover their position. And that's why above the daily trigger, you get strong moves to the upside. So check out here, price broke above the daily trigger. We got a strong move to the upside. Now, actually here, you can see the trigger cross. There was no counter trend move, and you could see that the move ended up being really powerful. The trigger cross happened at like 27, and because there was no counter trend move, price ended up moving up $10. It's a really nice play, especially if you're playing with options. I mean, how long did it happen in? July 5th to July 21st. So if you would have won options 3 weeks out, $35 calls, you would have had $500 intrinsic value, and you probably could have gotten them for less than 60 bucks. So that's 1,000% move to the upside. So beyond, definitely very interesting. Let's keep our eye on it above 16. So you know what? I'm just going to put this in my channel. Beyond, above 16. Now, what helps with these streams is that now you guys know the setup. So you guys know the thesis beyond the trade. When you're taking the call out, you're not jumping in blindly to trade and risking your money. You know the risk to reward potential. You know why we took the trade. If it works, it works. It was a great setup. It should have worked. If it didn't work, these are the kind of risks we take in the market. Not every single time it's going to go our way, but you can see that there's a great reasoning and a thought process to go long above 16, especially because you can literally put your stop loss right below 16. Tesla above 238. Okay, just writing this down on my channel. So this seems really promising. Let's keep going through the list. Let's look at Roku. Okay, again, we start off looking at the air pockets to see if there's good potential. So 54% up to the weekly trigger, 220% up to the monthly trigger. Let's look at the monthly velocity. So the monthly velocity, nothing telling me that price wants to go to the monthly trigger at 175. So although that would be really nice, just Anemoi's not screaming that yet. Weekly velocity, okay, yeah. Okay, so price does want to go to the weekly trigger here. Let me show you why. Here is your most extreme print to the downside. Price at the time, let's remove some of the noise. Now remember, guys, wherever the bullish divergence happens, that's which trigger price wants to attack. So here's our most extreme print. Price was, let's just call it 76. Weekly velocity, negative 4.81. I'm ignoring this print. Okay. We'll call this one, this one is our first bullish divergence because price is 74, but weekly velocity is going up, not down, so bullish divergence. We're going to call this one our second bullish divergence, 63. This is all sideways, sideways, sideways. Now we're coming down, but we're going to call this one the low right here. This is our third bullish divergence. Now that we had 3 bullish divergences, we can expect price to come up and attack 85, but there's a couple of steps it has to get over before that happens. Before I continue, does anybody understand the way I counted this? Does anyone have questions about the way I counted it? Nobody? Okay. So here's what needs to happen for price to attack the weekly trigger. Couple of things. 1, price needs to break above the daily trigger at 56.26. And then 2, the hourly trigger needs to come up and cross above the daily trigger. Now the thing is, this cluster is pretty tight. I mean, you could just see it from looking at it. The difference between here and what was the stock we were just looking at? Beyond. No, Beyond's pretty tight as well. Okay, so yeah, they are both pretty tight. So, you know, it's a 2 trigger cluster setup, which isn't as strong as a 3 trigger cluster setup, but with the weekly velocity, with the weekly bullish divergences telling us that price wants to revisit 84, we could already long above 56 with our stop loss below the hourly trigger. So what you do is the way I play this is that you can't wait for price to break above the daily trigger when you have 3 bullish weekly divergences, because in front of your face, price might just attack 84. And meanwhile, you were waiting for the hourly trigger to cross above the daily trigger. So this is where you use risk management to size appropriately. So price breaks above 56.26. I go 3 weeks out or 1 month out and I buy $70 calls for Roku. Okay. And I buy, let's say, 25% of my allocated position. If price moves up to 60, maybe I'll add another 25%. If price comes back down to the hourly trigger, then I'll add another 25% with my stop loss the entire time below the hourly trigger. So then let's say I'll get the trigger cross, the hourly trigger will cross the daily trigger. I'll throw out the rest of my 50% into the play with my stop loss below the daily trigger. So let's play this out in real time, all right? Let's say tomorrow, Monday, price at 54.55, and we see price at 56.40. I'll go ahead. Wait, let's just check the daily velocity. Daily velocity is -1.3. Okay, so this helps because the daily velocity is telling us that price is actually not ready to move above the daily trigger yet. We have at least 2 days, because even if price attacks 56.40 tomorrow, the daily trigger, the negative daily velo, because it's above 0.1, so it's not like 0.0 where it's insignificant, it's 0.1. Like, for example, see here how it was 0.01 and price broke above the daily trigger. Look. Here, 0.01, and price broke above the daily trigger and started moving to the upside. Ended up getting knocked back down, but whatever. Here, it's still -1.3. So let's say price moves up to the daily trigger tomorrow, and then on Tuesday, we don't have enough negative daily velocity for us to tell us that price wants to reject at the daily trigger. So price moves up to 56.40 on Tuesday, and I go long 25% of my allocated position to $70 calls expiring in 1 month. I'm going to get them for dirt cheap. IV is going to be dirt low, and if price moves up to even 75.80, I made 1,000% on those calls in a month. Okay, now let's play out all the scenarios. Scenario 1, price keeps moving and is on its way to 60. Maybe I'll just let the position ride. Maybe I'll close it all out. Maybe I'll add some more. But, I'm already in a very good winning position, and I'll sell my position, let's say, on 3 bearish divergences, on the 5-minute or on the 1 hour. But now I'm in good hands. All right, I'm already in profit, and I'm not too worried. Let's say price comes back down below the daily trigger. Right away, I could stop out. So I bought at 56.40. I could stop out at 56.20. Teeny loss. Let's say price does nothing and just stays at like 57 for a couple of days and the hourly trigger crosses above the daily trigger. Then I'll add the rest of my 75% of my position. I'll still have my stop loss right below the daily trigger and I'll ride it long. No matter what, the risk reward is incredible because I have a teeny amount of risk, all right? Even if I go 25% of my position in and price gets slammed back down, I only went in with 25% of my position. So teeny risk. And, the reward is that we might get 84 and the 3 weekly bullish divergences tells us that price does want 84. Let's see. Yeah, I mean, look at if we're just looking at the daily velocity. So price just came down below the daily trigger right here. And by the way, the next couple of stocks I'm going to go over quickly, but now you guys understand the thought process that goes into all of this. -892, -85. So here's your most extreme print. Price is 70. Here's your 1 bullish divergence, 2 bullish divergence, 3 bullish divergence, price goes straight to the daily trigger. Now it comes down again. Here's the most extreme print, -853, price is 58. 1 bullish divergence, 2 bullish divergence, 3 bullish divergence, price is already right back at the daily trigger. So you guys have to trust Anemoi that when there's 3 weekly divergences, price is going to go straight to the weekly trigger. Whether it does or doesn't isn't our concern. We play the rules of Anemoi. It'll work more times than it doesn't, and you'll make money more times than you won't. So, again, excellent risk to reward. So Roku is above 56.26. Let me put that in the channel. Okay, now let's just speed through the rest of them. So, Shop.
Jiro, I reset my list in the main trading room there.
Okay. We're going to get to it. Yeah. Before I move on, does anyone have any questions? Okay, everybody, a little shy tonight. No problem. Shopify has an 18% gap to the weekly trigger. Monthly trigger is 123% gap. Monthly velocity, nothing telling me price wants a monthly trigger. Weekly velocity, here you guys go. Let's give you a perfect example. So here's your most extreme print to the downside. Price was 33. 1 bullish divergence at 30. 2 bullish divergence, it's pretty much the same low, 30.1 and 29.32. But here would be your second bullish divergence, and here would be your third bullish divergence, right? Is that clear to everybody? Here's your low. Here's your most extreme print. Here's your first low, 30.1. I don't count this because it's weekly, so we go by macro moves, and this is only a 70 cent difference. So here's your second bullish divergence, and here's your third bullish divergence, and what do you know? Price is on its way to attack the weekly trigger. And look at the daily trigger and the hourly trigger. So you see how the hourly trigger crossed the daily trigger right here. Where is it? Right here. Here's your cross. Okay, look at this. The hourly trigger right here is 29.04. 29.10, 29.15. Here's your cross, and look at the counter trend move right back down to the daily trigger. This is very normal. This happens almost 90% of the time. And then right after the counter trend move, you could ride this up to the weekly trigger. So pretend we're watching the stream 2 weeks ago, last week, all right? Monday was October 24th. Pretend it was last Sunday. I would have said exactly what I told you guys for the last 2 plays. I said, let's take the long above the daily trigger. So we would have went long right here, 29.98 with 25% of our position, just in case price just runs to the weekly trigger. Then once the hourly trigger crosses the daily trigger, we're going to add another 25%. The entire time we have a stop loss below the daily trigger. So we're going long at 29.95, but our stop loss is below 29. Then if there's a counter trend move to the daily trigger, which there was right here, price was 29.06, the daily trigger was 29.14, the daily velocity was positive. Although it wasn't incredibly positive, it told us that we're not going to be super worried that the daily trigger is just going to fall apart and price will just plummet. And then after you had the counter trend move at 29, we'd be sitting pretty at $34, right? We'd be sitting in 200 to 500% profit in 1 week, and we would have streamed on Sunday, and we would have said when we get the break above, we go along with 25%. When we get the hourly trigger cross, we go along with 25%. When we get the counter trend move, we finish our position, and there you go, straight to the weekly trigger with 3 bullish weekly velocity divergences. So shop, we can definitely long this to 40. Let's take a look for bearish hourly divergences. So here's the 3 trigger cluster setup. Here's the move higher, hourly velocity. So here's 1 bearish hourly divergence, actually 2. So this isn't a great long right now, simply because there's already 2 bearish hourly divergences. So here's your price high, hourly velocity. Here's a new high, lower hourly velocity. Here's a new high, lower hourly velocity, 34.60, 34.52. So on the hourly, every new high is a divergence. On the weekly, you need a legitimate new low. So here's what we can do. Shop, if we get a pullback to the hourly trigger, we can long it to the weekly trigger. So that's what I'll put on my channel. Shop, pullback to HT, long to weekly trigger. Okay? If it shoots up and attack the weekly trigger, no problem. But it seems to me like it needs a pullback to the hourly trigger first. And so if we get that, you can long this to the weekly trigger. Now, you could also take 25% of your position now in case it just shoots up and the velocity repairs itself, meaning if Monday morning we open up and price makes a new high and the velocity is higher than this, then it saved itself because it made a new velocity high before making 3 bearish divergences. But I'm the kind of guy that likes great entries and exits, especially when we have a list of 5,000 stocks to look through. And so if I get a pullback to the hourly trigger at 32.20, daily velocity looks nice. Yeah, daily velocity looks nice and strong. Ooh, looks really nice and strong, actually. So, okay, with this kind of daily velocity, yeah, you kind of have to take 25% of your position right away. Because when you have this strong daily velocity, it could counteract hourly bullish divergences. So here's what we can do. We can go long Shopify on Monday with a stop loss below the 5-minute trigger at 34.05. If it falls below the 5-minute trigger, we long again at the hourly trigger. If it doesn't fall below the 5-minute trigger, then we only ride 25% of a position instead of a full-size position, which is fine. And our target is the weekly trigger. So Shopify, shop 25% of position, stop under the 5-minute trigger. Okay, next. You know what? I'm going to skip a couple of these. Sorry, MB. Still love you, but I don't want to be on here for an hour, and we only have 13 minutes left. So, and I want to get to some of half bakes too. So let's just look at Meta. Okay, so Meta, I went long on Friday. My logic is because throughout this entire sideways pinning, and I mean, guys, this is called Ivy Crush. Okay, so there's an algo in the market that Anemoi identified, and when the 1 minute trigger and the 5 minute trigger are like this, it's kind of funny, but it's called the Ivy Crush algo, and you usually see it on meme stocks into Fridays, and it tells you that they're going to pin this thing all day. But what's crazy about this is that this is called the IV suction. So sucking out IV, sucking out IV, sucking out IV, sucking out IV. IV on contracts are deteriorating throughout this entire process. When the 1 minute trigger and the 5 minute trigger are hugging like this, your contract values are deteriorating. So what the best way to play this is that right here, the IV is at the very, 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 very lowest. So what you do is you wait until price breaks in either direction. Now I'm leaning up because you could see the negative hourly velocity is repairing itself like crazy. And also, whenever price is 7% away from the hourly trigger, you can almost automatically assume that price is going to revisit the hourly trigger. Now, that doesn't mean that price needs to go up straight to the hourly trigger. Price could remain sideways, maybe move up and down a drop while the hourly trigger comes all the way down. But you have a really good shot of an hourly trigger reversion. So basically, what you do is you wait for the pin to release. And the second the pin releases, IV on its own jumps 30 to 50%, and your contract doubles on a 30% price move. Dead ass. All you need to do is wait for the pin to be released, and then Ivy comes flooding back. So I went long the 105C. I sold the 110C. So that means that I bought a call at 105. I sold a call at 110. And if price gaps down on Monday, what I'll do is I sold the 110 for, let's say, $50. I'll buy it back for $10. So I made it 80. If I bought and sold 3, then I made like $120 on it, and then I'll just add to my 105s because I think we're going to revisit the hourly trigger this week or next week, or even if we move up to 103, 104, that's still really good profit. That's Meta. All right, we have 10 more minutes. Let's go over just a couple more. If any one of you guys that are watching has one that you want me to look at, quickly put it on now. WM and WCN for short plays. WM. Okay, so it looks like price broke through a 3 trigger cluster to the downside. This is really bearish. See how price broke through the hourly trigger and the daily trigger at once. The hourly trigger crossed below the daily trigger, which even if we weren't looking at the weekly trigger, this is bearish. Look at the daily velocity is keep on getting more extreme with each new low. So that tells us this move is not even close to done yet. The hourly velocity, this is a capitulation bar. So it's normal for price to revisit the hourly trigger, but this is a great short. And price is below the weekly trigger. So that means we got negative weekly velocity. Yeah, so the predicted print for next week is more negative than the previous week. So hourly velocity is getting more negative. Weekly velocity is getting more negative. I like this short play. So the way we play this is we come down to here. So it looks like price wants to revisit the hourly trigger. What we do is we short 159. So WN short the HT at 159. Let's look at a couple more. Again, if any of you want something analyzed, if 9 more minutes, just put it up now. WCN. Also, I hope you guys learn a little more about Anemoi from the stream, even if none of these plays end up working out. Okay, so this is indecision. We don't know which way price is going to break, but it's very simple. WCN. So this is a great play. So WCN, we long above 133.69, and we short below 13256. So this is a 3 trigger cluster setup. You can see how all the triggers are within 1% of each other. And so because of that, whichever way price breaks, it's going to be a really powerful trending move. All right. Weekly velocity is negative. It's negative. So this gives us a downside bias. So if we had to guess, we would say that price is going to break down. Monthly velocity has been stepping down. So that fits the idea that that it's going to be a short in the end. Now look at this. The monthly velocity is calculated on the first of every month. So the previous monthly print, this monthly print that you're seeing, 1.09 was calculated when price was up here at 135, 136. So that means on Monday, if price closes at 132, monthly velocity will go down once more. And so this is going to turn out to be a great short down to the monthly trigger. So we want to short this to 120. If price breaks below the hourly trigger, oh, and it's also on a 3 trigger cluster here. So this is a 6 trigger cluster. So basically, whichever way this thing breaks above 133.69 or below 132.56, it's going to make us money. It's a 6 trigger cluster. Watch this. You know what? We're going to come back to this in 2 weeks, everyone. And we're going to see that it either shot up 10, 15% to the upside or down 10, 15%. But also, what a beautiful, beautiful example of that trigger cluster we're talking about. Look at this. The hourly trigger crossed the daily trigger right here. You got the counter trend move back down to the daily trigger. And then look at focus on the hourly trigger and the daily trigger. See this airplane where the hourly trigger kisses back to the daily trigger and airplanes right off it? Price ended up going from 124 to 146 in 1 month. That's incredible, incredible gains. So again, guys, don't sleep on airplanes and trigger crosses. Let's do 954. Let's do one more. Tilray, I'm long, so let's quickly go over that one. I'm long. I didn't really play it seriously. I just bought 4C lottos, but look at the weekly velocity. So why didn't price come back? Where's price? Okay. So look at this. Here was your most extreme print. Price was 307. Here was your bullish divergence, and now price is coming back to the weekly trigger. So above 406, this thing can go parabolic. Why? Because this is going to be the first time that when we look at the monthly velo, when did this print happen? Okay, I missed this print. When I was looking at it back here, it was looking good because steer stepping up. This isn't nasty though. I still think we can probably move to the monthly trigger above the weekly trigger. So all eyes on Tilray above 406, by the way. Let me just make that very clear. Tilray above 406. And also here, look at this. When you see these setups work enough times, you'll start trusting it. But here's your cross. See the cross right here? The hourly trigger crosses above the daily trigger. And guess what? Price comes all the way back to the daily trigger before the explosion. So 9 out of 10 times after the important cross, you first have a counter trend move before the move up. All right? So it's very important. You could go 25% of your position in case it's the 10% that price just explodes to the upside. But 9 out of 10 times, you're going to have a counter trend move back down. Let's look at this. Here's the cross, and you see exactly when a cross is, counter trend move back down to the daily trigger before, having this incredible move up. It's all about having patience for the counter trend move. We have time for one more. Let's do half-baked empty lunchbox. Are you watching? Just give me your last one.
Yeah, one sec. Just double check this list quick.
All right.
I mean, PLTR was looking interesting to a few of us. I don't know if you want to look at it.
No, it was. I checked it out earlier today. Someone.
Did you? Okay.
Yeah, I like it a lot. Somebody mentioned it. I thought that was a good one. Okay, so let's break it down.
Okay, cool.
So first, 11% upside air pocket to the weekly, 68% to the monthly. Look at the monthly velo. Nothing telling us it wants the monthly yet. Weekly velo. Obviously, a whole lot of accumulation going on. Oh, so one more thing for all the people new to Anemoi. You cannot have bullish divergence unless somebody with huge pockets is accumulating. All the bullish divergence does is telling you, are the big guys buying or are the big guys not buying? If the big guys are buying, they're going to bring price right back up to the weekly trigger. If they're not buying, price is going to keep making new lows until somebody eventually buys. And when they do buy, we'll see it in the weekly velocity. So here's your most extreme print. Price was 840. Here's your first bullish divergence. Here's your second bullish divergence. Here's your third bullish divergence, and straight to the weekly trigger. So I do think price is going to go to 959. Absolutely. Price is currently at 862. Let's look at the hourly trigger and the daily trigger. So let's zoom in here. Okay. First of all, you have your trigger cross. Right when the trigger cross happens, there's your counter trend move right back down. And once it hits the hourly trigger, then you get a nice move up. There was obviously 1 or 5 minute divergences here that would have, we would have been looking at the day trader chart and have been able to get out. But, this is how you play it. Price breaks above the daily trigger, you go long, and then as soon as you get the trigger cross, you sell right there. So we could have went long at 7.95, sold at 8.44 in the span of 2 days. 1 day, actually. So again, weeklies, probably that's a 100 to 200% win. 7.95 to 8.44, probably like a 60% to 100% win. Either way, pretty nice. And then you could go long again on the contact of the hourly trigger. Price was 8.06, bounced off the hourly trigger, right back up to 8.57 in 1 day. That's a nice play. And then, but again, you suffer from this counter trend move back down. And then when you have this trigger cross, price moves up, counter trend right back down to the daily trigger. This is why I always wait to really size up until after the counter trend move. So once the hourly trigger crosses, I do go in 25%. But when the counter trend move happens and the hourly trigger already crossed, I'm in my full position, 100% of my position. And look how well I would have done. Bought at 8.04, price high was 8.99. I could guarantee you there was bearish divergences down here. You know what? One more minute. Let me just show you guys that there was a tell right here. October 26th, PLTR. Let's see what the tell was. Looks like it's a capitulation print. Yeah. So this print does not belong. Okay. So you have velocity, 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 and then boom. This is a capitulation print. When you see prints that just dwarf the previous prints, that means that velocity is running too hot and it needs to cool down before continuing higher. So this was your tell. Let me just check the velocity to see if there's anything. I mean, this is also a capitulation print on the 1 minute and the 5 minute. This is also capitulation on the 5 minute. You see, it just dwarfs the previous ones. So there's always a tell to get out on Anemoi. All right, guys, I hope everybody enjoyed the video. If you have any questions, ask them now. Otherwise, hope everybody has a good night, and let's crush it this week. Somebody's now going to tell me that you guys couldn't even hear me the whole time. Is anybody alive?
Did the stream start?
My heart dropped for a second.